Historically, Bank Nifty has always outperformed the benchmark Nifty 50 index in all of the bull runs. But this time around, it is yet to happen. But of course, if you look at the past few sessions, Bank Nifty index has gained in tandem with the benchmark index. Of course, at this juncture, investors do tend to be a tad bit cautious on whether the gains in the banking space will sustain or not. So let's chat about this and more with Neha Dave joining us from Moneycontrol Pro. Neha, welcome on board. First things first, I'd like you to help our viewers understand the correlation that is between Nifty Bank as well as Nifty 50.
First of all, thanks a lot for having me. So as you rightly pointed out, that there is a very high correlation between Nifty and Nifty Bank index. And historically, Nifty Bank has always led the rally in the market. But that has not been the case in the last 1 year. So if you look at the last 1 year performance, Nifty index is up by around 49%. And the rally so far has been mainly driven by metals. So Nifty metal index has outperformed significantly, and it has almost doubled in last 1 year. However, on a relative basis, financial services has underperformed, and there are various reasons for this underperformance. One of the main reason is that financial services is a representation of the macro economy, and the last 1 year the economy has been hit by the pandemic, and which was getting reflected in the fundamentals and the results and earnings of this financial services stock in terms of the asset quality weakened. There was less of disbursements, and there are various other issues. So basically, it was reflecting the weak economic phase which was impacted by the pandemic, and hence overall the bank Nifty has not put up in terms of performance with Nifty in the last 1 year. Now, going forward, we think that Bank Nifty is at an inflection point, and going forward, a next leg of rally in the market has to be driven by banks and financial services. The reason why I mention this is because the weight of financials in Nifty is around 36%, and they have to participate for the overall market in Nifty to move up. And if we look at the composition of the index, also the key constituents of Bank Nifty, the top 5 stocks, that is SBI, HDFC Bank, Axis Bank, ICICI, and Kotak. All of them are fundamentally very well placed, and they are looking. I mean, their earnings is also looking up, going into FY23. So Bank Nifty will participate and take the overall markets further in the coming months. Yeah.
Well, off late, if we look at the markets, the benchmark indices, they've been on a record setting spree. And if you look at sectoral indices and the contribution coming in, you have the likes of IT, FMCG, metals as well, which have quite actively participated in the recent uptick. Bank Nifty, however, has underperformed. Given what you just said, can we expect the last leg of this bull run to be dominated by banking and financial names? Do they have enough potential to do that?
Let's look at the key components, what could drive the banking stock and earnings from here on. So if we are talking about, say, credit growth, and credit growth is, as we know, is muted. The latest number which has been reported as per RBI data is that the overall bank advances grew by only 6.5% on a year-on-year basis. However, the key positive was that the retail lending is looking very strong and continues to grow at around in double digit. The growth was around 11% YOY as of July end. So most of this top 5 banks which we talked about will try and capture the retail market share, and the growth will be driven by the retail lending. And margins also will continue to be stable because the cost of funds is also at all-time low. And fee income will improve as business activity is expected to improve in coming months. We also have festive season coming up, the credit card disbursements and will improve into the coming months. So overall, the top line growth for the banks also looks healthy. Now, the biggest driver for the earnings, however, will be the credit cost. Now, the biggest concern in the last 1 year, we all know, that has been the asset quality for banking stocks, and that was the primary reason of the relative underperformance. But now assuming that there is no third wave or further disruption, and with the economic activity improving, we see that the asset quality tends to will improve going forward into the second half of FY23. FY22. And even if, say, asset quality has to moderate further, there is not much to worry. And the primary reason being, most of these banks, have created additional provisioning, and which will help them, to meet the future contingencies. Now, this is very important, So we think that FY22 earnings for banks will be mainly driven by normalization of the credit cost, and earnings is set to improve, and hence, this stocks would participate in terms of there will be some upside to the banking stock in coming months.
And finally, Neha, what matters most, I'm going to ask you, which stocks are you betting on right now, whether it's the fundamentals or potential for a further re-rating on back of all the factors that you just mentioned? Which banking and financial stocks should we look at?
Yeah, so if we have to talk about individual stocks, again, one of the key trend that has emerged from the pandemic is that the strong has become more stronger. So the top 5 banks in the country are gaining disproportionate market share, and they will continue to do so in coming months and years. So our pick also is accordingly, SBI, HDFC, ICICI Bank. All these 3 looks very interesting at this point in time. Now, if you have to talk about individually about the stock, SBI, for instance, SBI has done phenomenally well. It has been an outlier in the banking, among the banking stock. The stock has doubled, almost doubled in last 1 year. But despite the rally, the stock is currently trading at below book value in terms of FY23 book value, and there is a lot of potential because a lot of its subsidiaries are also doing well, and the bank's earnings have also are also gaining momentum because of the lower credit cost. So that is one stock to bet on. Apart from, so if we keep aside SBI, which is a public sector, and there might be some apprehension about corporate credit still not picking up, ICICI Bank and HDFC both looks interesting. Now, between the two, we have seen that HDFC Bank has underperformed massively. HDFC Bank is up only 10% year to date, and as compared to ICICI, which has delivered some around 35% return. So HDFC Bank has primarily underperformed after the RBI's restrictions and embargo last year in December. There was some restriction on its credit card business and digital launch of digital businesses. Now we have seen that just recently RBI has partially lifted the restriction with regard to its credit card business, and this was weighing on the stock performance. And we think that going forward, with lifting of the restrictions, the stock might do well, because in terms of valuation also, if we see, HDFC Bank is trading at around the valuation which is at the discount to its long-term historical average valuation, and it is obviously the retail lending market leader in the retail lending space, and should do well in the coming months. So that remains one of our top pick as of now, along with ICICI and SBI. And Kotak and Axis Bank also will participate. There are some minor concerns. If with Kotak, the valuations are always rich and have always been rich, and the growth is something that market is looking from Kotak's number. And if the bank delivers, we might see further upside.
You've not really mentioned any banking names from the mid and small cap space, whether it's a Bandhan Bank, Federal Bank, RBL. They've also started witnessing a positive upside, at least in the last few sessions. Is there any potential in any of these smaller lenders, or should one stick to blue chip heavyweight names right now?
One of the key trend that we have seen post the pandemic, or after this outbreak of the pandemic, is that the larger ones are at an advantage, the larger players, and more specifically in the banking sector. So the larger banks will continue to gain more market share as compared to the smaller ones. So our preference obviously would be for the larger names, though there might be some selective names which looks interesting in the smaller and the mid cap space. Say for example, CSB Bank. The bank has done well in the last 1 year in terms of stock return also, and is aggressively growing its gold loan book. And the bank is also now in a very interesting phase. It is like trying to transform into from a break from an old private sector bank and to a new age private sector bank, and there is a new management in place. So that bank looks very interesting. The stock has corrected after the last earnings, primarily because of rising NPAs in this gold loan portfolio, but we think that that was just a blip because of the pandemic-related restrictions, and there will be more recoveries in the coming months, and stocks should do well.
All right, Neha. Well, I hope our viewers are taking note of all the key observations and recommendations as well that you've been making. Thank you so much once again for chatting with us.
Thank you so much.